right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your host, Thomas Kopelman, and here with me this week is Roger Ledbetter. So, if you followed along with the podcast for a while, Roger's been on here, I think, 2 times. I think this will be your 3rd time on here at least. Just kind of one of the go-to resources in the tax world. And so, with the new tax bill coming out July 4th, I think is it the 3rd, whatever day it officially came out, I felt like, it was our job to come on and kind of share everything. So I've done a Twitter thread, I've sent out a newsletter, but I think a lot of people actually need to listen because there's a lot to actually dive into more than like permanent 2017 tax cuts, right? I think there's a lot of financial planning on each one of these topics for us to talk about. So honestly, let's dive right into it, Roger. I mean, let's just give us an overview of kind of what you think of this bill. Which is actually kind of a funny way to do it because I think everybody's view of this is like, whoa, okay, I don't know if this was maybe the best idea. Like, we already have a deficit issue. Sure, we're hoping GDP and tariffs can kind of help offset some of this. I don't find so many people that are like, I love it, great policy, but I'm sure you agree, we do love it for our clients.
Yeah, I think that's fair. I think if this bill passed 8 years ago, I think we would have been happier than we were with TCJA. From it kind of carries on. My takeaway is it carries on the status quo for business owners pre some of these even phase outs that started to happen, like bonus, and then like 163J. I deal a lot with real estate. That kind of started to get some teeth last few years. So it kind of peels it back to the glory days of TCJA. But I think this is actually a bill that helps employees out more so than TCJA did. Like things like overtime and tax on tips, and then seniors, like everyone got a little piece of the action. And so I think from a taxpayer standpoint, I think it's a really friendly bill. The problem that you mentioned is very expensive. Like I was just kind of laying out, I was doing some kind of like the Sankey diagrams where you see, okay, what's paying for the bill and like where is it going? And the whole thing is done on leverage. It's leveraged up. It's going to increase deficits. But no one really, maybe they did, but it didn't feel like we talked about this like this 8 years ago when TCJA was passed. It was just, it was fine, but it's changed.
Yeah, because I don't, obviously I was younger, but I obviously don't remember them talking about the deficit like it was. And obviously the deficit's in a worse place, higher interest rates, et cetera, makes it sting a lot more. But it is kind of surprising. And what I've been surprised about also with this bill is how wrong people are about what's inside of the bill too. Like even if you look at politicians, they're like, no tax on Social Security, no tax on tips, no tax on overtime. When in reality, none of that is actually true. It's more of like there's a phase out or there's a deduction or something, but there still is tax on those at certain amounts. But I think that segues us right into, where do you want to start? What's the first one that you want to talk about?
Yeah, I always think about, I kind of plotted out, I threw a thread out yesterday or Sunday, getting the days mixed in, but it was kind of, I think of like an individual tax impacts and then like a business tax reform or business tax extension. So I'd say let's talk about individuals and kind of what happened there.
Okay, perfect.
Yeah, so I mean, it's tax rates obviously have kind of carried on from what they were pre-2018, 2017, pre-TCJA, which was kind of Trump's first tax reform bill that he passed in his first term. Lowered tax brackets. I think of like top tax bracket. The top tax bracket was 39.6% in 2017 prior. It went down to 37%. It stays now at the 37%. So we're not going to have this bump up in rates that we otherwise would have had.
Yeah.
And so that's a good thing for people.
Yeah, and it's good for basically everybody, right? Because I think sometimes people say, okay, top marginal rate 37 versus 39.6. Okay, great for higher earners. But really after 10, instead of, you're in 12 now, it would have been 15. Instead of 22, you would have been in 25. Instead of 24, you'd be in 28. Those are like the main ones. So that kind of that middle earner part. And obviously if you make a lot, you still get to take advantage of those brackets. But in general, that is still good for low to mid earners as well.
Yeah. Yeah, bingo. Kind of in that same vein, we see standard deduction increasing, right? And so TCJA, I'm going to make a lot of references to TCJA because we're extending these on the personal side. And so it was half of what it was now in like 2016-17, the standard deduction. And it doubled that in TCJA. That keeps that and it raises it, like another $1,500 for married filing joint.
You're right. I think I was just working with my EA on my team. We were working on a plan. I was like, hey, we got to update this for this tax review because this introduction 31.5. And he was like, wait, what? And I was like, yes, for this year. So it's like part of this bill is confusing because some things are this year, some things are next year, some things are permanent. That will probably go away with the next administration. Some things are for 4 years. And so like it does you do have to dig into this to understand what's going on.
Yeah, exactly right. But this is so standard deduction is good point is permanent, air quotes, right? We'll see what the next administration comes up with. Along that same line is child tax credit, like that increased, and so we'll see that. I think that's been kind of marked for inflation as well, and so these increases should increase with us.
Right now it's like $2,200 per child.
I think that's right.
That's what I figured it. That's what I thought as well. And then there's a phase out.
Yes. Yeah, we have a phase out there, and then same thing with individuals. We have, this is one that kind of stung employees with TCJA. For individuals, you used to be able to itemize and take a itemized deduction for unreimbursed employee expenses. So think of things like unreimbursed mileage, meals. Right, if you were an employee, you could take a deduction if you itemize for that. TCJA cut that out. That cutout gets extended. So employees that were looking to take this deduction or looking to get back into it pre-17 kind of gets bit as well.
Okay.
And then, so now we have mortgage interest deduction. So it used to be like $1 million in mortgage interest or mortgage principal that your interest would be based off of, your interest deduction. That went down to $750, and you get grandfathered in with these. And so if you have like an old mortgage, like you don't really got to worry about this. So new mortgages, that $750 cap remains in place. So you still get the deduction for mortgage interest, but it's just capped at $750.
This is one that I think I've brought up a bunch of times that people just have no idea about. They just think, which again, for the average person, it doesn't apply, right? Not many people, unless you're pretty wealthy, have a mortgage above $750K. But right, like if you have a $2 million mortgage or a $750,000 mortgage, you get to deduct the same amount. It does not really matter. And that's just something that I think people miss.
Yeah, I think a lot of people miss it. And I don't know enough about TurboTax, but I think TurboTax can miss it. We come across a lot of clients who, if you don't know the right override in the or the right place in the software to put it in, it'll just pass it right through. And usually those get flagged. Those get flagged pretty quickly by the IRS for an audit.
Okay.
So I'll kind of keep on. Those are kind of just to me like what got extended on the personal side. And so I look at this kind of these new deductions we're having. And so these are, I forget the guy on Twitter, but he had a really good layout. These are like above the line deductions. They're not itemized, so you don't have to itemize. But these are kind of these 3 to 4 year windows that you were talking about. So they're effective for 25, which is just crazy. We're halfway through the year and we're creating deductions. And the last year they're in effect is 2028. Mm-hmm. And so this first one was this no tax on Social Security. And so if you read the language in the bill, they're actually using the old placeholder for personal exemptions. And so again, pre-TCJA, everyone had like a $4,000 exemption. And it was kind of like a standard deduction, but like the more people you had on your tax return, the more dependents, you would get like a $4,000 deduction off of your income.
Okay.
So it uses that same placeholder. And so it assigns these, if you're 65, I think it's 65 by the end of the year, you get a $6,000 personal exemption or deduction, I guess, for each person on that return. This does have a phase out. So as income or modified AGI, we'll just call it income, as that gets over $150,000 or $150,000 for married filing joint, you're going to phase out pretty quickly of this. And then ultimate phase out is $250,000. So it's like a $100,000 phase out range.
Yeah, far from no tax on Social Security. That's for sure.
Yeah.
It's beneficial, obviously, but
I think if you do the math, because X amount of Social Security will get excluded if that's your only source of income. If you do the math,
$4K or something. Yeah,
it's supposed to shake out to where if this is all the income you're making and it's a moderate amount, it won't be any tax on it. But this is a far cry from wholesale no tax on Social Security. And I think there was limits on what they could touch, right? You can't really play with Social Security. That's a whole different type of tax. And so I don't think they really wanted to touch that. And so they had to kind of do this back end way.
Okay, that makes sense to me.
Continue on with kind of these new, I kind of group them like these four new deductions that were introduced. So this other one is this no tax on tips. And so this is a deduction of up to $25,000 for equal to tips received. And this has a phase out as well. So it's the phase out actually starts pretty high, pretty favorably. So it's $300,000 married filing joint, and I think by $550,000 is when it gets fully phased out.
Pretty good. Honestly, makes sense to me, right? Like, I'm sure. I know there's some carve outs in here to make sure this isn't abused in the same way. Like, I can't start taking tips. But in general, right, like if I tip somebody at a restaurant or hair salon, like that is above the service cost, it feels like that should be tax free anyways. And this is one that you said, right, there's this kind of 4-year carve out, but even a lot of the Democrats have been saying like they actually don't think this is enough. And so this is one that, I think Nate Sosa, I was listening to him talk about this, that they really believe will be kept or extended to be even a higher amount in the future. Who knows? But
yeah, this is what you can like see it when bills are passed. You just kind of know the games that are going to get played. You know people are going to try and slip this through. To me, like this one, and then we'll talk about like no tax on overtime. I feel bad for the payroll providers. Like the amount of information these guys are going to have to capture and hassle clients for and answer questions on. It just sucks for them. So yeah, this is one like CPAs will get it. We'll get our W-2. We'll get the W-2s with this box 32 ZZ, whatever it's going to be. But yeah, so it's helpful for low income earners. I think it should have a lower phase out, but that's just me. But you're right. I think to my point earlier, people are going to try and play games here. The IRS, I think, has 90 days to send out interpretations. So list of industries where this is accepted and to kind of exclude, yeah, you're right, engineers or CPAs can't start taking tips and think we'll be able to exclude it.
Yeah. And I think they probably picked a higher phase out just in case of spouses, right? Like if you're a hairdresser, like you probably make 100 to 150 maybe before tips. And so then they give that 150 single. But then if you're married and have somebody they're like, oh, we don't want you to not get this at all. Because 300K if you're in California or New York, but isn't that crazy of an amount.
Sure. Yeah, that's a fair point.
Cool. So then we got overtime.
Yeah, this is going to be a tricky one. I think this is probably a source of a lot of confusion where this gets passed and people just think, okay, great, I'm in. I work 40 hours, my 41st hour, I don't get taxed on anything. And that's not quite how it works. So it makes a reference to like FLSA, Fair Labor Standards Act, Section 7. You have to go look it up. And like Money Cruncher CPA did a good post on this. We broke it down where he's talking about how only this, if you work time and a half, only the half is considered overtime for this purpose. So I think his point or his example was if you make $40 an hour and you work overtime and you get paid time and a half for overtime, so $60 an hour is what you're getting. It's only that $20 an hour extra that is eligible for this deduction.
I didn't know that. Yeah, this is one that I'm kind of curious to learn more about as this gets added in. So I'm like, okay, hey, like my team, my enrolled agent on my team, like we have busy seasons, right? Like we kind of ended the year and then we have like a, Q2-ish time where we work a lot and he works more than 40. Is that a way that I could structure and kind of do his bonuses tiered around that and help him tax-wise? It'll be interesting to figure out because the phase-outs, right, are the same as tips, right? It's still the $300K and $150, and it's still for up to $25,000.
I think you hit on a point that a lot of employers are thinking, which is how can I be first to market to bring in and sell this as an advantage?
Right. If you can say, hey, I want to net you this amount, and I know this part is tax free, I'm actually going to give you less. Like I think there's two sides of this: what more money for you, or less money paid by me.
Yeah. Exactly. The person who can like nail that and bring that to market to their employee or their potential employees and recruiting, like, hey, come work with us. Yes, your hourly rate is less, but it works out more if you're working out this amount. I think those people are the winners. So I think there's a big opportunity here.
Really interesting. Okay, cool.
Car loan interest I had next up.
Yeah, this one's interesting to me too because you can deduct up to $10,000 of interest paid right? So these are all, you don't have to itemize to get these, but 10,000 of interest paid with a phase out of start at 200, fully at 250 is like, okay, so if you have $100,000 car at 7%, right, you're not even touching 10K. And so most people that are in this 2 to 250 range, they probably shouldn't have more than a 50K car, and that's top end, right? So even 10%, like this seems like kind of a wild numbers for me. I figured they would just give it to everybody and not have this phase out, or it'd be lower than 10K.
Yeah, they originally had it. They have what is it? They have RVs are in here. Like campers and RVs are allowed, but they originally had like trailers and ATVs. Like they had other stuff that maybe was meant to include like more recreational, random type.
You give people a benefit on.
Yeah. So sidebar was like, pre 1986, all interest was deductible, and you could deduct everything, the credit card interest, whatever. I don't like this deduction because you're right. It encourages debt, and it encourages high levels of debt. Right? I think this is an employee friendly bill, but it's also like a bank friendly bill, right? Yep. So you're encouraging bonus depreciation is usually done on leverage. 163J we'll talk about to add back to not get penalized on leverage. This car note, like it's leverage. QSBS, you can now buy bigger companies and have QSBS, more leverage. So this is like a leverage-friendly bill too. That, yeah, I don't know. I think this was something that was promised, and they wanted to get in there, and
interesting.
They got it.
Okay, so those are all these like other deductions that still exist, whether you itemize or take the standard. Is there any other ones on the personal side that you want to talk about?
One that kind of got a couple people talking is this wagering losses. So it used to be that you can only you can't take gambling losses in excess of gambling income, but the way you report that is different on the 1040. You got to pick up your 1099G, like your gambling winnings on your income, and then you have to itemize your gambling losses. What this new law says is you can only take losses. You can only take up to 90% of your actual losses, and so even if you lost money that year, you may still owe tax. And so it's a difference from what we had before. If you follow all these, like, I don't know, these guys who professional gamblers or whatever they call themselves, those guys are kind of getting squeezed on this.
I actually have a couple clients who are professional gamblers, so this will be an interesting one to think about for sure. Well, I feel like the few other ones on the personal side to mention here, one of them is the estate exemption, right? So estate exemption, we've been talking forever about it being cut in half. How do you plan for it? And like, I always took the approach of like, I would wait and see, especially once Trump won. It felt like this was going to be extended, right? We don't really want to give up liquidity and lock dollars up if we don't have to. So this actually gets extended to 30 million, 15 million each person, and that's going to be adjusted for inflation. So it goes up even just this year. And then above that. So I think that's huge for obviously the high net worth space to be able to keep things a little bit more simple. Because everybody thought it was going to go back to like this 7.5 number and be half of what it will be.
Yeah, I think people partly relieved with this were like estate attorneys who were like staring down the barrel of a gun with, I'm sure, just a backlog of people like screaming for estates to get done and finalized before the end of the year. So they probably had a good run the last year or two when we weren't really sure what was going to happen with this, of people just go ahead and doing gifting, doing planning. I think they'll still have a good run. I think it's still necessary. Asset prices are going to continue to go up with all the borrowing for sure. So I think it still makes sense. But yeah, I think those guys are probably breathing a sigh of relief that their December was not going to be just completely wrecked.
Nice of the government to pass this early so people didn't have to make these decisions without the info. The other two I'm going to hit on really quick. One is dependent care FSA next year is going from $5,000 to $7,500. I think that's a good addition, right? We all know childcare is one of the most expensive things and things that hurt most Americans. So being able to pay more, I still think $7,500 is kind of crazy. I think they should probably do more like what's the average price of daycare across the country, and that's how much you'd be able to pay pre-tax. Because nowhere it's $500 a month or $600 a month, whatever that math ends up being. Another one I want to hit on is HSAs. HSAs will be available with more plans now. It's going to be in bronze and catastrophic plans. So I think that's a good addition for people. I mean, right, if you have to spend so much to be able to deduct it, we might as well have pre-tax ways to be able to pay for it. So that one's really good. And then the other one that was kind of interesting was the change on charitable deductions, right? So there's this new like above the line $2,000 charitable deduction if married, 1,000 if single. But on top of that, there's now this like 0.5% AGI floor. So like if you make $1 million, right, and you give $5,000, that $5,000 you don't benefit from at first. It's only above that amount, which to me means DAFs become even more impactful. Lumping charitable giving becomes more impactful because even if you're itemizing, but you give 20K a year, only benefiting at 15 of the 20, why not do the next year? And then you get, 35 of the 40 versus 30 of the 40. I mean, in California, that's still a couple grand added tax benefit.
Yeah. When the TCJA was first passed, charities were up in arms because it increased the standard deduction so much. People were like, "Oh, you'll have no tax reason to give," and so that was the gripe. And so I think this was a nod. This was a nod to them. Okay, everyone can get some charity. Like when COVID happened, I think this was what it was like $300 above the line. So that was kind of the vibe. Yeah, it's back at a bigger amount. I think it's a good thing. I think it'll encourage people to give more. But you're right. There's a pay for. There's the other side where it's, if you're a high earner, you want more bang for your buck, you got to overcome that threshold.
Yeah, exactly. Okay, shall we move to business side of things? Okay.
Yeah, let's do it. So like I always start with QBI. For me, QBI was, I think if one kind of tax reform thing has really impacted my clients' lives and structuring and planning around is QBI. So this is, I'm sure your listeners know, but this is a 20% deduction on pass-through income. So income that comes to you via K1, from like a partnership, from an S corp. Schedule C is eligible for it. Some REIT dividends are eligible for this, and so it's a big number. If you make if you're a really successful business owner and you make $1 million on a K1, this is a $200,000 deduction that's coming to you.
As long as you optimize.
Yeah. So that's one thing we weren't sure what was going to happen with QBI was like, okay, are there going to be new limitations? Are they going to change limitations? And so, we're still seeing the same strategy for QBI.
I was hoping the elimination of SSTVs, right? I know that was like a conversation there. Some people said that they thought in some of the proposals there was no longer an SSTV status, which for everybody who's listening, like neither of us, a financial advisor, lawyer, doctor, attorney, we don't get this deduction when we're past that phase out. But in this bill, right, they made the phase out bigger. Instead of $100,000 is that phase out. Now I think it's $150,000. So technically for some of these SSTVs who are in that income range, you'll get it. Obviously my clients are different. Like most of my clients are 900 million plus in income. So SSTV does not get it, or you get to continue to get it and still have to optimize wages. And there didn't become that 23% change like they were talking about as well.
Yeah. I was relieved to see the 23% didn't change.
It's a weird number.
Talk about PTET, like it was going to be just way too complicated.
Yeah, exactly. Okay, cool. What do we think next?
Let's talk PTET. Like, let's go down SALT. So SALT is kind of personal tax, kind of business. So the SALT limitation, current rule is $10,000. So you pay state income tax, property taxes, you get $10,000 of a deduction on your itemized Schedule A. Now and this is 25. This change is eligible for or effective for 25. Now it's a $40,000 deduction on Schedule A, but there's a phase out. And so the phase out starts at 500, and then by 600, I think you're completely out. Yeah, back to 10. So you'll still get your 10. There's always a kind of a reversion back to 10. And so this is it's a helpful thing. If you look at the scoring, they count this as a revenue raiser, because pre-TCJA, which is like the baseline they're using for scoring, there was no limit. Like you could deduct all your state and local tax. So this is they're calling this like a win, that like the cap of 40 instead of unlimited. It's helpful, but yeah, if you're a high earner, you're over 600,000, As an employee,
Yeah.
you're kind of toast.
It doesn't really apply to a lot of people when you actually break down the math behind this, right? Like I was looking at one today for a client who they make like 400 and they live in Colorado. Like it didn't make that much of a difference because the tax rate was too low. And then between, you have marginal brackets or you have lower taxes, right? And then property taxes, they weren't even close to really capping it out. So it's like, a lot of my clients fully phased out, they're going to get the 10K. So then you really look and it's like you either live in a really high property tax state like Texas, for example, right? If you have a couple $1 million house in Texas or even lower, you might hit that full 40 right there. You might have California or New York or Minnesota potentially, rates get pretty high. But in general, like hitting 40 is pretty hard for people under 500K, and at least in a good amount of states.
Yeah, it's a good point. Yeah, you may not, the people really eligible to take the full 40, you're not going to get the full benefit of it.
Yeah. It'd be nice.
Yeah. To our point earlier, there's been different versions of this bill, right? It started in the House, and then first it was like a draft, and then it went to the final House, then went to the Senate and back. We've gone to like 3 or 4 versions of this bill. And so in the one out of the House was this, PTET limitation. So this pass-through entity tax. And so one of the strategies, and Thomas, you do a really good job of talking about this, is where business owners can make an election to pay this tax through their business, to pay this personal income tax, the state income tax, through their business as kind of a workaround. And so there's then no cap on that deduction. It flows through to them via the K-1, and the states allow this because they get their money, and the IRS respects it. There was in the House bill, the first version of this, they kind of cut those games out. And I think even the Senate bill had originally had drafted some limitations on like up to 50% of this. And so I'm glad there's nothing there. So if you're a business owner, especially making over 600,000, it's a huge pickup.
Well, it's huge because this is what really applies to my clients, right? I mean, most of my clients are, I have a good amount in Florida and Texas. Doesn't really apply to, obviously, but California, New York, Minnesota, Illinois, et cetera. Like PTET is like life-saving for them. For some of my clients, if you make, let's say $2-3 million, your state taxes are $100,000 to $300,000 in some of these states. And so being able to deduct that federally is 25 to 100,000 plus in tax savings for a lot of people. So I was really happy this existed. I would have rather SSTB gone away and QBID, but PTET, but it is complex. I would say the vast majority of my clients coming in, their old tax teams didn't have them in PTET, whether I work with a Texas tax team, but I moved from Texas to a different state now and they weren't aware of it. Or, hey, I'm a sole prop. I've never thought about why I need to be a partnership or an S Corp to get PTET, right? Like, and I have a new client, they were like bummed that they won't have PTET for this year. And I'm like, you should be mad at your last tax team, right? Your last tax team should have put this on your radar. You shouldn't be a sole prop, right? You need to be a partnership or you need to be an S Corp. But like, if you're not paying your advisor or your tax person for planning, they're just taking your returns and filing. They're not going to look for ways to save you money because that's not in the job description of what they're paid for.
It's complicated because like then every state has different rules, right? So some states you have to make the election by X amount. You have to pay every single quarter or by this amount. Some states are, file with the final return after you extend. It's
a lot, right? March 15th, and you have June. Then some states it's June 15th, and some states it has to be in. Some states you can basically say you're going to do this later. Some are quarterly. California 6/15 and 3/15. Like it is a lot to learn and know and figure out how to manage it. And some states don't even allow it.
Yeah, right. It's. We pass around this chart like, okay, here's the updated PTET chart. Who's doing what? What are the rules behind it? Like, assign your clients to which chart and who's gonna let's make sure we stay on top of them to get those payments in, get the elections in. But yeah, it's a lot to wrangle. I'm glad it hasn't changed, right? It was complicated enough.
And that's a big workflow as a business, right? So now you have remind you of your 4 quarterlies. You maybe still have states because maybe you have income outside of the business. Then you have PTET I have to remind you on. That's a whole job as a business. Maybe I have 10 to 12 reminders for you on different payments throughout the year. And PTET especially, right? Like the other ones you can miss and have it under payment penalty. PTET means you miss and you lose the whole deduction. So then that's higher urgency than some of the others.
Yeah. And to your point, when that's a $25,000 tax difference, those are not fun conversations.
Yeah, exactly. Okay. Cool. Feel good about that one.
So I've got bonus teed up next, a favorite topic of mine. So obviously we do heavy real estate in our practice, and so bonus depreciation, cost segregation studies, things like that are big to us. So it's again permanent, right? So you got to use that because you never know when they're going to come back and repeal it. But 100% bonus is permanent. The 179, Section 179, which kind of acts similar to bonus depreciation, has also been expanded. I think from $1 million a year up to $2.5 million a year.
Things heavy machinery, big cars, things like that.
That's right. There's a wrinkle here. Kind of some of the tax alpha arbitrage is bonus depreciation is eligible for 100% after February or January 19th, 25, so after Inauguration Day.
Yeah, I guess that's fair. Well, I'll still say weird.
Yeah, so bonus depreciation after 119, you're eligible for 100%, but 179, the bill reads after 12/31/24. And so if you're a business owner and you bought a big piece of equipment January 15th or 12th or whatever, you're not completely out of luck. Now 179 has different rules, and you can't like run a loss with 179 like you can with bonus. But if you're a profitable business and you're thinking, crap, I bought something in the first 2 weeks, 3 weeks of January and I'm screwed, not necessarily. 179 is still an option for you, and then you can turn around and bonus the rest of it after that.
Yeah, I figured this would come back. I mean, Trump's a big real estate investor himself, so I mean, real estate's a good investment, but it's especially good because of the tax benefits like bonus depreciation. So for any of the real estate investors, any business owners who are looking to buy real estate to operate in, anybody with heavy machinery, etc., great time to take advantage of it. It says permanent. Who knows, based on what political party of the next 4 years. If you're a high income earner, I'd be buying in these next 3 to 4 years.
The other wrinkle, last bit, is then it's for property acquired after 119, so not necessarily placed in service. So people may think, I was building an apartment complex, I started construction last year in 2024, and it's going to be placed in service tomorrow. You may want to check the rules on that before you think you can just cost seg everything and get a run. Things like there's like binding contract rules. If you had a binding contract prior to 119, you may not be eligible for that.
Okay, that makes sense. Okay, we still have a few more. Where do you want to go next?
Yeah, I had this excess business losses, which is kind of a short one.
Yep.
So this is one that if you have a pass-through business, I think, again, like real estate, and you generate large K1 losses, you're capped on how much in losses from those K1s can be used to offset other income on your tax return. An example would be if you have a spouse who's a high earner on a W-2 making $1 million a year, and you're a real estate pro, and you have a K1 of more than five, or right now the cap is $626,000. You're capped at that amount. You can't use in excess of that $626,000 of losses from those K1s to offset that W-2 income.
Yep, carries forward.
Yep, exactly right. And so right now, the language is that's only tested once in that loss in that year. So if you have excess business loss, in our example, everything over 626 to $1 million, next year that converts to an NOL, a net operating loss. And so you can use up to 80% of your income, that NOL up to 80% of your income. Generally, you can use it up the next year. Under, I think, the Senate or the House language, those were going to stay excess business losses and would get retested on that $626,000 cap. So that didn't get passed. We like this. This is good.
Yeah, that's really interesting. So even if you had $2 million of losses, or let's say $1.5 million, you use the 626. Next year you have another 8, whatever. So you could use all of it, basically.
Bingo.
Nice. Okay,
Yeah.
That's a great one.
So another one near and dear to my heart is 163J. And so this is 163J. 163 is kind of the section where the Internal Revenue Code talks about interest expense. And so it really affects a lot of our real estate clients. If you're in rental real estate, you leverage up and you do a large cost segregation study, you generate large losses. If if you have a lot of interest expense, that may get limited out, meaning you may not be able to deduct, as it was last year and the year before, you may be capped on how much you can deduct of that interest expense. And there's a calculation that was done to say, okay, well, here's the adjusted income, because you can take interest up to 30% of this adjusted income number. And so starting in I'm gonna get it wrong. I think 22, 23, interest or depreciation was no longer an add back. So if you had a large cost segregation study, you used to be able to add that back to determine how much interest you can deduct. So this restores that. This bill restores that. You can now add that bonus depreciation back, which makes sense because we're doing 100% bonus depreciation. So I think the two kind of go hand in hand. But we like this. There's elections we can make in real estate to kind of still get around that, but they're permanent. Anytime you're making permanent elections, I don't feel great about that. But yeah, this is a real estate friendly tax bill.
Okay, that one makes sense to me. I was a little curious to understand how that worked, but that was a really good explanation.
Good.
Cool. Okay, so we probably have 2-ish left, I think. QSBS, and then maybe a little on opportunity zones.
Okay.
Okay. I mean, QSBS is an interesting one to me because I think this one kind of came out of nowhere. Like within the last couple of weeks, I didn't hear anybody talking about more QSBS. A lot of my clients were like, "Hey, do you think QSBS is going to go away?" And my thought was probably not. It is permanent, right? But it's not sunsetting. So my assumption is unless they say they're getting rid of it, I'm going to assume something stays. But they enhanced it, right? So now QSBS, and I think the one thing before you go into this is not for your old stock. I've already had clients reach out and say, "Hey, does this apply to this stock that I have?" And it's no, it's only if it's newly issued stock, right? So anybody who elected C Corp in the last 1 year, stocks. Sorry, you miss out on it. I've been telling every client, let's wait for the last year before we make any entity election changes like this because we want to see what the new tax bill is. But in this new one, right, QSBS goes from 10 million to 15 million, but still, or 10x your basis, so it can still be higher. That's a cool one. But on top of that, right, you get this partial, right? So I have a lot of clients who are thinking about C Corp, but they're like, I just don't think I'll make it 5 years. It's going to be somewhere between 3 to 5. Is it worth taking the tax hit to move to C Corp as a high profit business? But it's not if you lose out on if you don't get QSBS eligibility, you're going to come out way behind. But now you get this at 3 years, 50%, 4 years, 75%. And then at the 5th year, you get 100% of that 15 million. Really, really great. And now more businesses qualify too because that cap was 50 million in assets is now 75 million in assets.
Yeah, maybe just that it was never marked for inflation, but I don't know why they needed this. I don't know why. We deal with QSBS and a little bit, and there's other shops that do this nonstop. But to me, QSBS is always, when we're advising clients, we just tell them it's a shot. Like, you need to be able to call your shot that this is going to be a stock sale as a C Corp when you sell. Because if it's an asset sale and you're a C Corp, you're going to have double taxation. And there's there's other ways around that. You can make an S election and wait 5 years for your built-in gains to burn off. So there's ways that even if you've done the C Corp, you can kind of plan it out as long as you don't have a bad shareholder. But it's kind of a call. And so we've had clients who are like, yep, nope, I know exactly how I'm going to exit. It's going to be a stock sale. Here's the likely buyers of me. And it works, and they save a lot in tax. But yeah, I think this maybe just was like an inflation catch-up.
Yeah, it's interesting because, well, one, if stock versus asset sales, something a lot of people understand. I have an episode already recorded coming out in the next couple of weeks on that I think people will need to check out to better understand that, because I think everybody thinks they have a stock sale when they're selling the business and you get long-term capital gains. It's not always that way. So make sure you check that out. But it's also interesting because most people getting QSBS above 10 million are very early employees or founders. And a lot of those people are stacking, right? Like if you're like, I'm getting well above 10 million, you're probably using other trusts and doing things. So I don't know if it was needed. I think the partial is probably one of the bigger benefits. Yeah. And you're going to surprise me, the partial, right, you don't always get to control that as an employee. And again, if you are an employee, it becomes more important if you have QSBS eligible stock to exercise it. Because a lot of people, I don't know if it's going to be worth anything. I'm going to wait to exercise it until I know. Well, you have to own it for 5 years. It's not granted for 5 years. You have to own it. So a lot of people give up QSBS eligibility because they're scared on that risk, which you obviously have to weather the two, but if you get QSBS, it's pretty good.
Yeah, it's a good pickup. I'm happy for those guys.
Yeah, agreed. Okay, what other ones do we have left?
OZ was I have a couple more, but like yeah, OZ for me was kind of a big one, right? Like Barrett on X or Twitter's Barrett Limper is really big in the space. He's a big developer, and so I think he's happy. He's generally happy with what happened here, and I think OZ investors should be OZ developers should be happy. What I'll kind of lay out the rules, and then maybe we just dive in on thoughts. And so it's what had happened when this first came out in 17 was you were able to defer capital gains into qualifying opportunity zone funds. Those then buy businesses, business assets, or like rental real estate that's a business in qualifying tracks. You're eligible by deferring that gain and contributing that gain in cash into the fund. You don't pay tax on that until 2026. So next year is still a realization event. So if you deferred gains in the last 8 years, into an OZ fund, you will pay tax on that gain effectively it'll be included in next year's income.
Yeah. Yeah.
And depends on when you contributed in, you may have a step up in basis. So you may be able to pay, it was 15% if you've held it for 7 years or 6 years, and then it's 5% or 10%. So there was a kind of a work down of the step up in basis before you pay tax on it for next year's income. That's still in effect. And so to everyone who contributed to OZ, good job. But next year, you're going to pay tax on that income, on that gain, at our current capital gains rates, which are still favorable where they would be. They're still good rates. What this does is it creates a 10-year kind of rolling OZ fund, OZ kind of anniversary. And so starting in, I think the first 10-year window starts January 1st of 27 is what I read. And so that's a 10-year window. So starting in July of 26 next year, everyone kind of weighs in. I forget, like governors or whoever decides where the tracks are in their vicinity. They determine where those will be. And then 1/1/27 starts a 10-year kind of deferral program. And so you can contribute capital gains into these eligible funds. The same rules, and there's a ton of nuance in here. You have to deploy so much of the capital by X amount of date, and you have to have a development program kind of written out.
Those OZ people working on that side.
Yeah. There's really smart people who do this, and so follow those guys, listen to those guys. But
Well, I was just gonna say, so now this is one that I didn't spend much time researching because I like them. I don't love them because of the lack of liquidity to really get the benefit. And I'm like, with how they've been before, I'm like, to defer for 2 years isn't worth it to me at this point. If it was deferral 10 years or something, it's different. But the way that it looked like to me, right, is okay. So if I have capital gain, I defer it by putting OZ. Is it 5 or 10 years till the capital gain I have to pay moving forward would be?
So I think it's a 5-year window when you defer or when you contribute that you then get to defer.
So 5 years I owe the capital gain. And then if I keep that investment, right now it was if you hold for 10 years, completely tax-free. But isn't it now like 30 years or something like that?
Yeah, so that's a really good question. So your first point is right. The 10-year, as long as you hold that investment for 10 years, you get a step up in basis equal to the fair market value at the time of disposition, the date you sell. That still applies. So it's still a 10-year holding window. The 30-year rule is that you can't go longer than 30 years holding this. And so at a max of 30 years, you get a step up to that appreciation. So this was so like before this, you could defer $1 million of capital gain in 2017 or 2018. I could hold this until I'm 85 years old for 50 years or whatever, and not take a step up until I decide to sell at 85 or 80, and I get like 40 or 50 years of step up gain there. This caps that at 30 years. So by year 30, you take the mark to market. Everything else is capital gain.
The other podcast I was listening to had this wrong. They thought that you had to hit 30 to get that tax-free benefit. And they were like, it just doesn't make any sense because what funds are really surviving for 30 years that people aren't going to take their funds from. So it's not that. It's just that you can't, that's the longest time you can do it and get all of that tax-free growth. Anything above that, now that's your basis and you start paying tax. And not many people are trying to do that for 30 years anyways. Like, people are really doing this for the tax benefits in general, because obviously there are good investments here, but in general, our assumption is that you will see lower returns in this space.
Yeah, it's a mixed bag. OZ is a mixed bag. I think there's some OZ. I have clients who are doing OZ and they're completely crushing it because of exactly where the tract was, and they're going to have a great exit event. And it looks really great. But
you can make your own, right? Like, I have clients who they've put up their own rental houses in qualified opportunity zones because they're like, I like real estate. I'd rather control this myself. I get the deferral on some capital gain that came, and then I also have the control of that asset versus hoping some operator does well.
Yeah, there's a lot of games to be played. Again, if you want to go down this road, talk to an OZ attorney, talk to the big dogs, make sure that, especially if it's large amounts of capital, get an opinion on it. Make sure, because there's people who think that they can do if they have kind of their own property already and they're just going to transfer it or sell it to themselves to create gain and put it in an OZ. Like, people get crazy, and there's a bunch of rules around this. So yeah, just full caveat, talk to the expert.
Yep. Okay, well, last couple minutes, what are the last few you want to hit on?
The random one I want to talk about was this qualified production property. So this is a big push for manufacturing in the United States, and I think people are sleeping on this a little bit. Construction has to start after January 19th of 25. But you put it in service, and there has to meet definitions. If you read the definitions of what meets this has to be a building that manufactures tangible property, like real property. You're a manufacturing business. It's eligible for 100% of basis deduction. So bonus depreciation of the entire building. So not just improvements, but like everything, the structure. And to me, this is a big thing. If you develop these types of buildings, I would be like screaming this from the rooftops that this makes the tax ROI incredible on this.
Going here, right? So for tons of people, one of the companies I work with, they bring a lot of private investments. A lot is in real estate, a lot is in industrial or things like that as is. Now this is going to become the best opportunity, right? So if I'm investing in it, obviously that'll be passive losses, but that can still be really good, right? I mean, if I have potentially a bunch of other passive income around that time, really beneficial.
Bingo. Yeah, if you can time it up and use it right, or if you're a real estate professional, like this could be really, really lucrative. There is like a 10-year look back, kind of a clawback. So if it's manufacturing and then you take the bonus, you sell it, or you change the use from a non-manufacturing, it's like a full recapture event. So not great, but I think there's a lot of businesses who will use this to crush.
Yeah. Okay, cool. Any other ones?
Those are the big ones. I mean, R&D's out there, but it doesn't really impact a lot of people. R&D expensing is back. It's good for CPAs, less brain damage. But I think that kind of covers it.
Yeah, I think those are all the main ones that we wanted to hit. And I really appreciate you coming on, because I think a lot of what's out there written-wise is only the facts, right? And so I think what was good here is we have to talk about how each one really applies to different people. Is it good? Is it bad? Is it kind of just out there but doesn't really benefit you, or does it really benefit you? And I think kind of the synopsis here is like, this is a big difference in taxes. Like, I did some looking with my clients, or kind of on individual clients, like what would be the impact if it just sunset, PTET went away, tax brackets went up. And it was like, for most of my clients, it was like 30,000+ more in taxes per year. So, obviously this is really impactful. Hopefully, between GDP growth, tariffs, et cetera, like it doesn't have the deficit hit we want, or that we don't want, because long term that's going to hurt us more than taxes will probably save us. But if things go well, this could be a really, really great thing. And it's honestly really great for, I'm sure, your clients in real estate, my clients as business owners and high income earners as well.
Yeah. Well summarized. Fingers crossed, tariffs, we'll see what happens with tariffs. I don't know. It's still going on right now, trying to work these trade deals. And so we'll see exactly how much that'll raise. This is an expensive bill, but you're right. If it encourages production and encourages GDP growth, we may be able to outpace that.
Yep. So I guess we'll see you in a few years. But Roger, I really appreciate you coming on. I know
Yeah.
around after messaging you a few days ago, we prepped for this, but saying, hey, as soon as it's got done, can you come on? You're the person I wanted to make sure, I had on. You did such a good job explaining everything. So appreciate the time and everybody. Thank you for listening. Make sure you go
Yeah.
follow Roger Ledbetter on Twitter. He gets all this stuff out. Great resource to follow. And if you're looking for help on taxes, and I know a lot of financial advisors are looking for more CPAs to work with, on the tax planning side, they're really, really good at what they do. So reach out. But everybody, thanks for listening. Please don't forget to rate and subscribe, and we'll see you back next week.